Well, lots to watch in the bond market these days, considering not just the big stories around trade uncertainty, but all that new spending by the U.S. government with Donald Trump's big, beautiful bill. Thomas Urano is co-chief investment officer and a managing partner at Sage Advisory. Great to have you with us. What's the mood of the fixed income world right now with stocks at an all-time high?
You know, the bond market, I think, is getting over the hurdle of the new bill. As we got through passage of this bill, the market has been very concerned about the deficit, the fiscal impact, what that means for Treasury supply. And we saw kind of this corrective move in rates here. But I think as we look forward, the market's thinking about growth. It's thinking about the labor market. It's thinking about inflation risk and ultimately where the Fed's taking policy over the coming quarters.
And ultimately, for anyone who is trying to think about how bonds would fit into one's portfolio right now, you know, whether or not the so-called 60-40 split makes sense, what do you feel about the outlook for, let's call it sort of good old-fashioned 10-year, 30-year bonds?
Yeah, I think the outlook for fixed income is fantastic. If you think about the bond market over the last 20 years, we haven't seen, say, mid-single digit, 4.5%, 5.5% investment grade yields. You haven't seen that since the 2008 financial crisis. Coming out of 2008, we went to 0% interest rate policy, quantitative easing, various policy impacts that drove yields exceptionally low. Coming through 22, as we got through this rate hiking policy, the bond market suddenly found itself in a position to offer yields of, say, 5% on investment grade fixed, which looks very compelling, very competitive from a risk reward standpoint. The bond market overall is supposed to be that ballast. I think it's struggled over a number of years to be that. But as we've gotten to this elevated rate regime, offering a decent amount of income, and more importantly, is the potential for lower rates down the road, it creates the potential for return and that balancing impact in your portfolio.
It's interesting. We had a conversation earlier about the U.S. dollar, which on this Monday was finding some global appetite. I know sort of broadly speaking, there had been a shift away from the greenback, but given everybody's talking about long-term spending by the U.S. government, what are you going to be watching for when it comes to the appetite for any new supply of U.S. government bonds? And I think we're continuing to actually even watch that this month.
Yeah, so that is the big concern, right? I mean, tariff policy has that angered some of our trading partners. And here in the U.S., we obviously rely on a lot of external foreign capital to participate in the bond market and finance federal spending. So that's been a concern of the market overall. I would say thus far, though, as we look through several Treasury auctions that have occurred over the last several months, there's not been a material impact that is discernible, meaning looking at participation rates from foreign sovereigns and foreign institutional buyers in the auctions. They've been running kind of on average, right? So at least what we've seen so far from actual data, it seems as though the international community is still participating in the U.S. Treasury market. I think another thing to keep in mind here is what the Treasury Secretary commented about in terms of their funding goals or their financing intentions over the coming quarters, which is to say both Trump and Bessent have indicated they'd like to lean to shorter maturities, lean into the T-bill market. There's certainly room to expand T-bill supply some in the coming quarters. But if they leave the average maturity of outstanding treasuries on the lower side, in anticipation of lower yields from, say, a new Fed chair or Powell ultimately lowering rates in the coming quarters, I think that creates an optionality for the Treasury to then extend maturities down the road, right? And that's important because it takes a little bit of pressure, supply pressure off that long end of the curve, 10s and 30s, as you mentioned, where there's some concern about foreign participation. If we can keep a lid on how much supply is coming out of that long end of the curve, I think the bond market can work through this.